That's just better than just giving cash out of your cash flow.
Right.
From the IRA, you're avoiding that income that you have to take out eventually.
Yep. The dramatic way to put it is a time bomb. I've seen that online. People call it the IRA time bomb.
Time bomb.
RMD time bomb or whatever. Yeah.
Welcome to a Wiser Retirement Podcast. Are you curious about being strategic with charitable giving before year end? I'm Senior Financial Advisor Shauna Theriault, and today I'm joined by Financial Advisor William Medcalf. Each week, we bring you practical advice on retirement, investing, and planning for your financial future. Don't forget to subscribe to the podcast wherever you're listening. Let's get started. I think this is the first time you've been on the show with your new title, right?
Yes.
I just realized
that's true.
that.
Yeah.
So exciting. Your promotion. Well
very
deserved.
Exciting. Thank you very much.
Very, very well deserved. We were talking about before the show because, we record these a little bit in advances in November. We just went on break and we went to a work trip to DC and then I went to the personal trip to DC. And so
yeah, Shauna's second home, DC.
Apparently it's becoming that. No, it was so fun because we went there as a group and I was like, this is so amazing. And so during break, I wanted to take my youngest there since she had never been to really museums. And I don't know, it was really fun.
Yeah, I hadn't been since I guess I was a little kid. And so going as an adult, I felt like I had a new appreciation for it. So I was very glad we got to go and it was great for the team, team building and stuff, getting to know each other better.
It was so fun, exploring, when I went, I know obviously women as a team, we went to a couple things, but we didn't get to do much because we were
at a conference and going to seminars and all that stuff. Yeah,
exactly. But going through all the museums and taking in the history, and it was so clean. I felt like it was really, really clean and just safe. And I don't know.
Yeah.
National Guard was everywhere. And I don't know, it was good. It was fun.
Yeah.
It was
It was a great time.
Absolutely. All right. Well, we're getting near year end. So this is airing November 3rd. So we're going to start talking about year end planning and things. And, this time talking about charitable strategies and when to give and timing of giving and how you can give. So I guess we can start off by just talking about, we're obviously at November 3rd already. We need to be thinking about the deadlines of when we need to get in our charitable giving.
Yeah. So Schwab will release, that's who we custody with. They'll release deadlines for, end of year requests. But for Wiser, we have, kind of a soft deadline, I guess kind of a range, just like mid-November to December 1st is when for end of year requests would be the best time to get those in for our client services team to be able to process those before the end of the year. So that's just a little tidbit there. If you're, you hear something in this podcast, then you might want to send a message to your advisor and let us know that you're interested in doing this and want to see you make sure that it, is a good fit for you. So.
Absolutely. No. And it just generally speaking, the deadline is technically December 31st, but you're spot on. Many custodians, they have harder deadlines depending on what you're doing. And we say custodians because there's multiple ways to do gifting. We're going to talk about gifting from retirement accounts. We're going to talk about, doing some securities. So we're going to talk about different ways of doing that, maybe doing, a DAF or donor advised fund. So there's several different ways to do it. And that's when you would use a custodian, but you can still just write a check to the charity and do it by 12/31. So there's multiple ways to give to a charity. There may be a better way to do it than to just give cash. And so we're going to talk about that and maybe strategies there to be helpful. But, generally year end is, the best time to do it. And so, just thinking about how does charitable giving fit into the overall financial plan where we're looking at a financial plan? I don't know if you want to expand on that a little bit.
So I would say the first thing is if you're a charitably inclined person, I would say that's when giving for tax reasons fits the best because you get a benefit for doing the deduction or, giving charitably, but, you are still giving up those resources in order to get that tax deduction. So it may not make sense if you're not, maybe more charitably inclined. That's totally fine. And we have clients that aren't charitably inclined. Yeah. So that's kind of the first thing is if that's not something that you want to do, may not make sense for you to give to charity just to get a tax deduction.
Yeah. And what's really funny about that, I hear this all the time. It's well, I want to get the tax deduction and, but most people do standard deduction now.
Yeah, exactly.
So the standard deduction is so high that if they're writing a check to charity, They may not even be getting the deduction and tax benefit of
That's
that. That
exactly
doesn't mean
right.
you still can't give it to the charity
Of
because you're
course.
charitably inclined and you want to do that and you have the resources and you want to. But you may want to look to see if you're actually getting a deduction for that.
Mhm.
So you may not be getting a deduction for that.
Exactly.
Yeah. Other ways it can fit into like broader financial planning is, you can look at if you're maybe getting a large payout this year
Yep.
from your company, or, you're getting a ton of RSUs or stock options, or, if you had a good year and you're self-employed and you're going to have all this income coming at you, that's a way to get a tax deduction.
Mhm.
So you can look at it from that regard as well. So where it helps you avoid income or get deductions on your tax return, which we're going to talk about the strategies of both of that. So, it may be a good fit for you if you're looking to do something like that as well.
Of course.
So we'll talk about bunching later, but, just really getting the overall tax deduction is where, there's some estate planning that it can fit into.
Mhm.
Obviously not by year end because we're not going to plan our demise, but it's when we're talking about how it fits into the overall financial picture or the financial plan, looking at some estate planning as well. If you want to leave something to charity, a lot of times, which we could do a whole show on this,
Yeah.
we would like to maybe leave the IRA to charity versus the other assets and give the other assets to, the family because there's
Mhm.
less tax implications. So, so charitable giving can fit in, when you pass away, but also when you're alive too.
Yes, that's great.
Common mistakes if you wait too long on the timing of, not hitting the deadlines and all of that.
Yeah. So, I mean, in order to get them for the tax year that you need the deduction in, obviously you need to actually make the contributions in that tax year. So that's
Yeah.
a big thing. And that's why we were bringing up the deadlines earlier. So, if you're doing it yourself, then obviously you want to make that donation before the end of the year. And then obviously if you're going through your advisor or custodian or something like that, then you need to be aware of their deadlines as well.
Yeah, definitely on top of that. So let's go into donor advised funds and how they work, called, acronym is DAF, DAF, Donor Advised Fund, and what it is and how it works.
Yeah. So this kind of goes to what we were talking about a minute ago. If you have a large payout or some sort of huge income year, this is something that you may want to look at. And essentially what a donor advised fund is if you don't have, let's say you don't have a charity picked out, but you want to gift a certain amount to charity and you have this large amount, you want to just go ahead and donate it. You can donate it to the donor advised fund without actually selecting a charity at that point. And you can do that later.
So you get like the deduction today.
Exactly.
So like, for example, you're working with your accountant and you find out that all this income has to come out and, I don't know, you're an S Corp and there's going to be a big distribution, or you find out your year-end bonus is going to be larger, right? Or you're just now looking at the estimates for next year, or maybe you have been looking, but you're waiting to see what's going on. It does give you the benefit of, if you have already one established. So the way that it works is you would work with a custodian. I know Charles Schwab has one, the Schwab Fund for Charitable Giving.
Yep.
But there's other means to do it as well, where you set up this account, you control it. So in other words, it can be an investment account, but you move the assets, cash or securities, we'll talk about each, to that account. You get the deduction now this tax year. But then it's not, like let's say you want a $50,000 deduction or a $25,000 deduction because that works with your taxes, but you don't necessarily want to give $50,000 to your church or this charity right now. You don't have to identify it yet. You can just put the money there. It's a tax deduction, and then you can give it to the charity whenever from that account.
Exactly. Yeah, that's a great point because it's not necessarily that you don't want to, or it gives you the ability to spread it over those, coming years. And so, like you said, if you just want to, give a certain amount to the charity or your church or whatever it is, then you have the option to do that, but claim that tax deduction in the first year where you give the, large amount.
Yeah. And I don't think it makes sense if you're like, okay, I'm going to give 10,000 to my church, so I'm going to put it 10,000 in the donor advised fund and then move it directly from there to the church. That doesn't make sense.
Yeah. No.
It makes sense to do this because, like, let's say you move that 10,000 to the donor advised fund, you get the tax deduction today. and you can actually invest it there. So they have investments in that account. So you could end up giving more than 10,000 to your charity over time, you know, and let it grow and then give it pieces of it and manage it like that. But, you know, you only get that one-time tax deduction.
Right.
Now, if you move cash in there, what is the limitation? I guess I want to talk about just limitations and deductions in general.
Okay.
So, you know, moving cash so you can move cash to an account like that, or you can move appreciated securities. However you give to a charity in general, whether it's a donor advised fund or otherwise, you know, there's limitations to how much you can actually deduct.
Right.
So, you know, you have to look at the itemization, itemized deductions, but also your adjusted gross income.
Correct.
You know, so the limitation is if you give cash to a charity, it's now
60% of your adjusted gross income.
Right.
So I guess if you had 100, just as a easy number, 100,000, then you can only deduct up to 60,000 in your income.
Right.
So.
Exactly. So if your income's really low, and, you know, I've seen it before where maybe there's a retiree who is very charitably inclined and maybe doesn't have heirs, and they have a large amount of assets and they're giving every year to charity because they are charitably inclined.
Right.
And maybe their income's like 50,000, but they're giving like a lot, you know, 75. You wouldn't get the benefit of the whole deduction of that. And that's an exaggeration.
Right. But it's a good example.
Yeah, exactly. And so, but they're like, I'm not doing it for tax. I'm doing it because I want to do that. And so they'd be limited to, you know, 60% of that income.
Right.
When you're giving appreciated securities. And so what we mean by that is, you know, let's say you own shares of a stock, let's say Coca-Cola, because we're in Atlanta.
Yep.
You know, your cost basis on that stock is maybe 20,000, meaning that's what you bought it for, but it's now worth 30,000. So, you know, it has appreciated like $10,000. You wouldn't sell that stock and then give the cash. You can actually give the stock directly, all or part of it, to a charity, and you're avoiding that capital gain.
Yep.
So what we like to do, what William and I do, is we look at, is a client charitably inclined? Because then we can give appreciated securities and you don't pay tax on those gains, right?
Right.
So you can literally gift the shares and then turn around and make the cash deposit and rebuy them. You can do it that way too if you want to stay invested.
Exactly.
You know?
Yeah.
So if you were going to give 10,000 to your church in cash, we'll give 10,000 from your brokerage account to your church. And, you know, that way, and then put the cash back in and repurchase it. You know, it kind of resets your cost basis. And now you're giving this appreciated securities to the charity. They don't pay tax because they're a 501c3 on that. So anyway, with a donor advised fund, you can give cash or appreciated securities, but that limitation, that 60% of adjusted gross income now becomes 30% of its appreciated securities.
Exactly.
So, you know, in the same example you gave, that 100,000 would just be 30,000 that you could deduct, you know, which is still a lot.
Yeah. But the government, I guess, prefers that you give cash instead of, you know, getting out of the capital gains tax. So
fair, fair, completely. But with a donor advised fund, it's kind of like, you know, we have some clients that set up private charities, but it's kind of like your own little family charity without managing a private charity. But you can put the money in there, it can still be managed, and then you gift out, you know, over time to whatever charity you feel is, you know, appropriate. So, so it's really ideal scenarios, like you said, if you have high income or if you want to spread it out over several years to a charity, it'd be a good way to do that with a donor advised fund. So that is one with the timing you would want to get with your custodian now, because it's the beginning of November, to say, you know, and some custodians may or may not have it. And if your custodian where your securities don't, that's fine. You can still do a donor advised fund in another firm.
Right. Exactly.
It doesn't have to be there.
Yeah.
So it just will take time if you're going to do appreciated securities, because then they have to transfer it from your current custodian to that other custodian.
Right.
Exactly.
Yeah.
Quick check-in. Have you thought about the legacy you'll leave behind? Download 7 Steps to Leave a Financial Legacy, a free guide from Wiser Wealth Management, to learn more. It's not just about wealth. It's about leaving a lasting impact. Go to wiserinvestor.com/guides to download your free guide today. Now let's jump back into the episode.
So let's get into other ways to give to charities, QCDs, qualified charitable distributions. I know we've talked about this. It's been around for a while now.
Yeah.
Actually for many, many years, but do you want to just touch on that?
Yeah. So a QCD, a qualified charitable distribution, is a good way to gift to charity out of an IRA. And the key benefit there is that it can stand in for your RMD. So, there's stipulations around that. You have to be at least age 70 and a half. But essentially you can give the RMD from your IRA account up to a little over $100,000 this year. I believe it's $108,000 this year. Directly out of your IRA instead of gifting cash. And so I was trying to explain this to my grandma, and I don't think she understands, because I think she likes
She's
to put
so cute. I love her.
put the check in the offering plate at church. So I don't know that
It hits differently that way.
It does. So I don't know. Anyway, but explaining this to people is like, this is, just it's a more efficient way to give to your church, because they still get the same, amount of money that you're, trying to give, but you get the tax deduction.
Yeah.
So
yeah,
it's a great way to get money out of your IRA, especially if you are charitably inclined.
Well, and so it's interesting, because when this whole thing started, the RMD age, and that's the RMD age, just to be clear, is the year you have, when you have to start taking distributions from your traditional IRA or 401k accounts, right?
Yes.
So, and you can only do this in an IRA, you can't do it in a 401k.
Right.
So, the required minimum distribution age was always 70 and a half for years. And then they changed it after the Secure Act, where it's like 70 and a half over a certain age, and then 73 and 75, ages 73, 75. But this is still a way. So like, let's say I like to use it in a couple of different ways. Let's say your RMD age is 73, but your IRA is like huge.
Right.
And let's say, so you're going to have to start required minimum distributions anyway. It's in the 3 years, a few years at age 73. And let's say you're giving to charity and you're not really getting the benefit because you have the standard deduction.
Yep.
Well, you can take, if you're 70 and a half, you can take some money out of your IRA, get directly from the IRA to the charity.
Yeah, right.
Not take it and then do it.
That's a key distinction there.
Exactly.
Yep.
And so you don't get to deduct it, but you don't claim the income.
Right.
So it avoids the income. So you're still going to get that in that example of 1099-R from the custodian, that you took out $10,000 or whatever amount it is. But you can avoid, it will not be taxable to you, because you're going to know it went to a charity and you're going to code it that way on your tax return. So you don't get the deduction and avoid the income, but you get to avoid the income,
right?
Which could be even better. Because when you're thinking about things like IRMA, and you're thinking about, other things that get taxed or looked at with your adjusted gross income, it may be better, because you're avoiding it completely instead of it being, it just may be better.
Yeah.
So that's one way where you can give directly from an IRA. Many custodians, I know when this first came out, it was like they were having to write checks and do direct to the charity. And now a lot of custodians will let you get a checkbook on your IRA so that you can do the smaller things if you want to.
Yeah, no, that's a great point.
Be careful, it's going to a charity though.
Yeah.
Don't write the grocery store a check. I don't even know you can do that anymore, can you?
I don't know.
I don't even think my kids know what a check is, other than the paycheck they've gotten a couple times and it wasn't digital. But, so you have to make sure that it goes, but you can write a check to the charity too. If you do like a lot of small ones, $3,000, $2,000, you can do that too. You just make sure you have to keep track of it, because you're responsible for telling your accountant or coding your tax return that way. So it's $100,000 per individual. So interestingly, it was $100,000. They're indexing it for inflation now. And so it was 105 last year, 108 this year.
Right.
So even if your required minimum distribution is like 15,000, you can still give more than that. So you can give more than your required minimum distribution, up to that threshold. So that's good. And it avoids, and said, then you don't have that AGI limitation then.
Right.
Because you're just avoiding the income. So if you're writing a check taking it out of your IRA, it's not like you have that cash limitation of the 60% of the
Exactly.
30%, right?
Right.
Yeah,
Yeah.
because you're just avoiding it.
Correct. Yeah.
So that's another way you may want to do that as well.
Yeah. And again, if you're charitably inclined, this makes sense. But, if you're looking in your plan over time and you can kind of project out what the tax rates are going to be in the future on your RMDs, because, that's an increasing scale. So as you get older, they're going to have you take a larger and larger proportion out of your IRA, which means that you're probably going to creep up in the tax brackets. This is another way that you can kind of avoid the future income, taxed at a higher tax rate.
Yeah,
so.
Completely. No, it's good. I think this is something that, looking at it every year, what makes sense for you, because sometimes clients come to us and say, well, I've already given to my church, every month. And it's like, well, okay, let's do this differently maybe. And I don't want to cause like a financial crunch for the cash flow of the church. So it's like, okay, maybe we look at the beginning of the year or whatever your situation is, maybe we look at giving appreciated securities from a taxable account or doing a QCD or doing a combination thereof. So that way you're satisfying, maybe you're satisfying that your contribution for the church or whatever charity that you've, said that you would help. But you're also looking at the taxes of that as well. So I think there's a lot to do with both of those strategies. That's just better than just giving cash out of your cash flow.
Right.
Because this is like a double, from the IRA, you're avoiding that income that you have to take out eventually.
Yep.
And, then you could.
The dramatic way to put it is a time bomb. I've seen that online. People call it the IRA time bomb.
Time bomb.
RMD time bomb or whatever. Yeah.
I feel like they
So
don't
dramatic.
think about all the deductions you got before that, though. You know
Right.
what I mean?
Right.
It's like, do you realize, all of that adds up over time, the deductions that are going in there, the deferring to your 401k, the deferring
Absolutely.
to your IRA, et cetera. But,
Yeah, that's another podcast right there.
completely
Yeah.
the time bomb of that. Exactly.
Yep.
So those are good strategies. And so, maybe doing a combination thereof. Other smart giving strategies. So bunching deductions.
Yeah, so that can work in conjunction with a donor advised fund. So we've already kind of talked a little bit about this, or at least the broader concept. But basically, if you know that you're going to give a certain amount to your church every year, you could, again, if you have a larger income amount, or maybe you just want a tax deduction for that year, you want to be able to itemize for a specific year, you could say, I'm going to take 5 years worth of the deductions that I'm going to give to my church and then bunch them all in 1 year and basically front load that in order to get a larger tax deduction for one specific year. And you can do that outside of a donor advised fund, whether it's, gifting appreciated securities. All of these things can work in conjunction with bunching, but the general concept is just taking multiple years worth of deductions and then putting them into 1 year.
Absolutely. And like, to your point, you may want to do that if your income's going to be higher or something,
Mhm.
or maybe if your charity has asked for a certain need, or, maybe they have a special project.
Right.
So you can do that as well. You
Yeah.
just want to make sure it makes sense for your taxes as well. But again, if you're just charitably inclined, fine. I wanted to mention, as far as gifting appreciated securities, there's certain parameters around that. If it's appreciated, that means it's increased in value.
Right.
You want to make sure that it's been held for that it's long term, that it's been held for longer than a year.
Yeah.
So in other words, if you, Coca-Cola wouldn't, but if you bought a stock and it appreciates in 6 months and then you go to give it, you're not going to get the full deduction of the appreciation. You'd only get the deduction of the basis.
Mm-hmm.
So it has to be held, because that's a short-term gain.
Right.
So you can't just buy something quickly, let it appreciate, and then gift it away and be like, okay, I didn't pay the tax on that, I just grew it for a charity. You want to hold it for a year to get the full benefit of that deduction on the dollar amount that you're giving. Just wanted to mention that. So it needs to be held for longer than a year. If it's held for less than a year, then you only get the basis, not the appreciation of it. So it's an important distinction to note that. So also those 30, that limitation. So in the example I gave you, where, somebody may be giving and maybe they, gave appreciated securities and they were limited to the 30% of adjusted gross income. you can carry forward that. So in other words, if you didn't deduct all of the charitable contribution, if you didn't deduct all of that, you can carry it forward for 5 years. And the client that I was thinking of that just has a few $1,000,000 and no heirs, who's giving more than adjusted gross income, that particular client has a large carry forward, yes, of charitable. And because you can only do like 30% of AGI, so that carry forward, but it's only for 5 years. And if you don't use it up within 5 years, then it's lost.
Right. So that's another thing where planning comes into play, because you can obviously, if say year 5 comes around and you don't have, you haven't used that up, then maybe you take more from an IRA or something like that. I would assume that could come into play there, so that you use up the deduction.
Yeah, you can. You would probably still end up paying more in tax if you
well, that's true.
use it up. I don't know. It just depends. But like to your point, that's where it's like, okay, where you can, look at it and say, well, what does this look like in the future though? So certainly you can, meaning what are the future taxes going to look like? And of course, we don't know what tax rates are going to do. We can only plan for right now. But if you're going to have really large deductions or distributions later, then maybe. Also, something I want to mention with the QCD, when it comes to inherited IRAs, you can do a QCD with an inherited IRA if you're over 70 and a half.
Yeah.
Many people that have inherited IRAs are not 70 and a half. So, and the new rule with you having to distribute it within 10 years has really put a wrench in that.
Exactly.
A lot of times as a grown child or, other family member, when you inherit those retirement funds, normally you're not
in
70
that age range.
Exactly. But if you happen to be, you can do that. I have seen where, some inherited IRAs were following the old rules, before the Secure Act, where you could stretch it over your lifetime. And then, they became 70 and a half, and then they were giving more to charity at that point and being able to avoid the income completely.
Yeah. Which is great, especially if you're still in a, high paying job where you're in a higher tax bracket. So that's good.
Or if you have an inherited IRA and then you have your IRA. And so you have all these IRA distributions, you can avoid. So you can do that with an inherited IRA. I just wanted to mention that. Other giving strategies, there are charitable trusts that you can set up, charitable remainder trust, charitable lead trust. Arun Gupta and I recently,
y'all just talked about this, didn't you?
Yes, it was the power of trust. It was like talking about 10 different trusts. So we did talk about charitable trusts in there. So I'm not going to go into huge detail. Just know that, you can do that as well. It's actually episode 307 that released on October 6th. So if you want to defer back to that, talking about different charitable trusts, that's something you can look into as well. And then maybe even private foundations. If you have a large net worth and you're charitably inclined, some families do set up private foundations. And so that's something else. There's different limitations with that. They're more not like a DAF, a donor advised fund. These are, more limitations in terms of deductions, but there's more work to be done. You have to have a certain dollar amount to make these worthwhile. It's a way to keep assets in the family, but is something that maybe you have a family cause that you're really passionate about. And you set up a private foundation to, either gift over your lifetime or a combination thereof, or when you pass, and then the family can continue to run that private foundation and make your assets more perpetual instead of just giving it to charity at the end. And so it can be long-term giving over time. There's the limitations I was mentioning is, with private foundations, you're limited to 30% of AGI to cash contributions and 20% of AGI of appreciated security. So it has a little bit of different limitations, and it does have a lot of administration to it as well. And obviously it'd have to make sense from an asset standpoint.
Exactly.
But it is an option as well. Arun and I did not get into private foundations in that episode. And then finally,
matching gifts from employers.
Yes.
Yeah. So if your employer is, passionate about charity and has a matching opportunity for you, that's great to take advantage of that as well.
Yeah.
Don't leave that on the table. It's kind of like a 401k. If you're already going to do it, then you might as well get the match from your employer.
Exactly. You can see, usually you can look in your benefits package or somewhere in human resources to see if that's an option.
Yeah.
So, they'll do that directly. So basically, as far as just some practical tips, doing this before December 31st, double check your deadlines for the contributions for the donor advised funds, the QCD securities transfers. Like you mentioned, we like to have things in by, end of November, no later than beginning of December, just because if you are doing, I remember, years ago, I worked at Charles Schwab and on the advisor side and, and we were it's crazy. They stay up like all night, processing all this. It's like all the year end stuff. And so the sooner you can get it in, the better. And that's why they make such hard deadlines, because if you're actually moving securities and doing X, Y, and Z, then they have to have time to get it all done.
Yeah. It's a lot of work. If somebody's actually doing that on the back end, right?
Exactly. Just making sure that you have proper documentation, letters, receipts, things like that.
Which, like, if you're doing a QCD and your custodian's going to issue a 1099, if you're doing it that way, that's going to be pretty easy to keep track of.
Absolutely.
But, yeah.
Well, to your point, let's say my required minimum distribution was 10,000, but I only gave 2,000 to charity. They're not going to show you that on the 1099-R. They're going to say your distribution was 10,000. You're going to have to know that 2,000 went to charity to tell your accountant or to put it on your tax return.
That's a great point.
So, you know what I mean? Because the custodian's not going to code that. They're just going to code it as a distribution. So they don't say where it went. You just have to know that and have to have documentation showing that too, which you will with the checks or with the receipts from the charity. If you miss the deadlines, and with securities, or you don't have securities to do or a QCD, you can do online giving or the check in the mail thing.
Right.
So there's actually, there's an IRS mailbox rule. As long as it's postmarked by December 31st, we're cash basis taxpayers. So as long as it's postmarked, it's not when the charity cashes it. It's not when they receive it or give you the letter. It's if you postmark the check in the mail by December 31st, then you're good.
Yeah, that's a great point.
Yeah. Anything else you can think of?
No, I mean, obviously all of this works in concert with your overall plan. And so I think it makes sense to have, a financial advisor and a relationship with a CPA to help you wade through all this, because these things may not make sense just in isolation. It might sound good. You might read an article online or hear a podcast, but, it really depends on your specific situation is what I would say.
Absolutely. And if you have questions, you can reach out to us. We'd be happy to schedule a consultation to meet with, one of our financial advisors, such as William now.
That's right.
Just to talk about this. And so you can do so by going to wiserinvestor.com or by clicking the link in the episode notes. Other episodes we've linked here. I mentioned episode 307 about the 10 various trusts that we got into. Episode 180, how does a charitable trust work? Episode 190, year-end tax moves, planning ahead for a stress-free tax season with Jordan Sute. He's one of the CPAs we work with. And then we just have other financial education videos. What is a charitable remainder trust? Linked in the show notes, and reduce your taxes and AGI by giving to charity. Well, thanks for listening. Today's episode. We will see you next week.
See you guys.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This podcast is strictly for informational purposes only and is not to be considered as investment advice or solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investor advisor with the SEC. The host and/or guests may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guests of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.